going to hit record here. The plan for today is to go over the homework for chapter 15. You know, just again in preparation for those who are going to start the test is going to start open on the 24th, but just to make sure that all kinks have been resolved. And then we'll do another cash flow example. And I just want to wrap up that free cash flow thing that we spoke a little bit about last week that I didn't do completely with you. And then I don't know where the time will leave us at that point. I mean, we might just touch briefly on what's happening in chapter 18, but I'm not trying to push you guys too hard. Whatever. Oh, and I'll go over, excuse me, one other thing, let me make a note. I need to go over the test prep sheet with you. So that's kind of what's happening today. And we don't have to make it to chapter 18. We can start that on Wednesday.
Perfect. But we still have time. We still have like 2.5 weeks, 3 weeks.
Yeah, we've got 4 more meetings. The last meeting I usually keep exclusively for final exam prep stuff. So, but one of these meetings, probably the 26th, we'll also go over the chapter 17 homework, but there's more than enough time. So that's why I'm saying I'm not going to push it with trying to get into chapter 18 today. If we don't have the time, it's not necessary. All right, so we can start. Let me share my screen with you so that you can see the homework. And for those who have just joined, we're going to go over the answers for the chapter 15 homework. Just in case there are any lingering questions, this homework was due recently, so you can see that it's past due. It was due on May 15 on Friday. Remember, I extended the deadline because we were having some issues with Wiley. All right, so I'm going to start here with brief exercise 1503. Stop me at any time if you have questions. And also, I think you can consider this a type of, I know you guys just finished the homework on Friday, but it's also like a type of review, given that our next test is opening on the 24th. So at least you can ask me stuff now that might help to improve your performance on the test. So Crane Corporation issued 2100. So this is not a dollar amount. This means it's the number of bonds. You may recall when we were going over this chapter, I said that sometimes the company will just issue one bond for a big amount of money, and sometimes they'll issue multiple bonds for smaller denominations, smaller amounts of money, and together that will make a big sum. It depends on how many investors they want to attract or how many investors they need. So this is the number of bonds. The 9% is the contractual, the annual interest rate. 5 years is the term. $1,000 is the face value for each bond. So if you want to record the total bonds payable, you have to multiply this out, right? 1,100 bonds times $1,000 per bond, dated January the 1st, 2020 at 100. 100 means they were issued at face value, meaning no discount and no premium. Interest is paid each January the 1st. That means that interest is paid annually. So you just will focus on the 9%. You don't have to apportion it for any parts of the year. So on January the 1st, 2020, obviously there's not going to be interest on day one because interest is a factor of time, right? Time has to pass in order for interest to accrue. So on the first day, you're just talking about recording the bond itself. Prepare the journal entry to record the sale of these bonds on January the 1st, 2020. Remember, sale means the same as issuing the bond. So it's basically just talking about the company borrowing, right, the money. And here's some instructions about not indenting the credit accounts, just type normally. So you debit cash because the company receives cash, and you credit bonds payable with the 2.1 million because there's a liability in that amount now. So 2.1 million is just coming from these two amounts being multiplied by each other. And then they ask you for the adjusting, you got to watch out here, right? The adjusting journal entry on December the 31st, 2020 to record interest expense. If you recall, right, if we're working with accrual accounting, even though we haven't yet paid the interest, on January the 1st, because the year is ending and all this interest is owed, we have to make a journal entry on December the 31st to actually record the interest. So you're debiting interest expense with 189,000. The 189,000 is coming from 2.1 million times 9%. If you guys had different different percentages, numbers, and so on, that's fine. Just remember that it's all going to end up being the same method, right? Interest is the principal amount times the interest rate. And if it's not for a partial period, that's the end of the calculation. So because this is an adjusting journal entry, you debit interest expense, 189,000, and you credit interest payable, not cash, right? With 189,000. And then they ask you, they kind of take you right through the flow. They ask you for January 1st, the following year. So it's basically the next day when you have to record the interest. What do? You get rid of the liability and you credit cash for the same 189,000. Questions there, anybody? Just making sure that no one's asking me anything. All right. So yeah, again, you need to be able to do bond issuance, interest adjustment, and the interest payment. Exercise 1502, kind of more of the same, but the drilling of how to do this stuff requires multiple attempts at it. So hopefully that is helpful to people. On January the 1st, again, Sheridan Company issued 540,000. So here you see they just give you $1 amount, which means it's going to be one bond payable at that amount, not multiple bonds payable for different amounts. 11% is your annual interest rate. 10 years is the term, so it would be done by 2030. Bonds at face value means the same as 100, so no discount, no premium. Interest is payable annually on January the 1st, same scenario. So you do your issuance, cash is debited 540, bonds payable is credited 540, no interest on the first day. So don't add interest to this amount or something like that. prepare the journal entry to record the accrual of interest. So you see how they change the language, but it means the same thing. This is the same as saying prepare the adjusting journal entry, right, at December 31, 2020. So please take note as you study of how these questions are presented, because I find sometimes when students do the homework, you're still in the mode of trying to figure things out, and you may not pay as much attention to the language that is being used. And then when you get to the test, you kind of look at every word and suddenly it's like, uh-oh, what does this actually mean, right? So accrual of interest is the same as adjusting entry for interest. So you're saying 11% times 540,000 gives you 59,400. You debit interest expense because the expense is increasing. You have to recognize the cost of borrowing, and you credit interest payable because it's an accrual. It's not yet a payment of interest. And the next day, on January the 1st, 2021, you get rid of the liability that you created over here and you credit cash. Any questions? All right. 1504, Wild Horse Company issues $1 million. So there's the face value, 10-year, the term 8%. 8% is the annual interest rate bonds, but now it's at 92. So if it's below 100, you already know that it's a discount, right? These bonds are being issued at a discount. So 8% discount with interest payable each January the 1st. So again, just an annual interest rate, excuse me, 8%. Prepare the journal entry to record the sale of these bonds on January 1st, 2020. We already know, based on what we discussed before, that bonds payable will always be credited at face value. So it goes in at $1 million. The cash you receive is going to be $1 million times 92%, which is 920,000. And then the discount, right, is a debit balance contra liability, discount on bonds payable at 80,000. So those two together will equal the bonds payable million on the credit side. So again, when you see this 92, you should immediately be thinking that this is a discount. The bond is being issued at a discount, and that you need to have a discount account as well. Please remember that the cash is what changes, right? What we receive changes when we have the bond going at a discount or a premium, not the bonds payable balance. This will always just be at face value. Assuming instead that the above bonds are sold for 103, so there you see it's above 100, so it's going to be at a premium. Prepare the journal entry to record the sale of these bonds on January the 1st, 2020. So 103, right? Again, the bonds payable goes in at face, so you should be able to get those points without any issue. Remember, it's cash that changes, so 1 million times 103% is 1,030,000. And then the premium is the credit for the additional 30,000. This is kind of, classic questions that you should be able to answer with relative ease. Anybody need any point of clarification there? I'm just checking again. All right. Okay. So this is a question that again is drilling the issuing the bonds at face at a discount at a premium, and they give you a principal or face value, and then you kind of have to run through the different scenarios. We had questions like this for our class examples as well. And then in the second part, they ask you to do a bond redemption at maturity. So prepare the journal entry. Oriole Company issued 2,430,000 of bonds on January the 1st, 2020. Prepare the journal entry to record the issuance of the bonds if they are issued at 100. This is easy because you just debit cash and you credit bonds payable for the same amount. There's no discount, no premium. At 98, you multiply 98% by 2,430,000 to get to your cash of $2,381,400. Notice our bonds payable still goes in at face value, and the difference goes as a debit to the discount on bonds payable account. And then 101, right, is a premium, obviously, because it's above 100. So bonds payable is still going to be credited with 2,430,000, but cash is going to be 2,430,000 times 101%. So you get more money, 2,454,000 and $300, and the premium is the difference between the cash that you received and the bonds payable amount, 24,300. Remember, when a discount on bonds payable is initially recognized, it's going to be a debit balance, and when a premium is initially recognized, it is going to be a credit balance. This is the type of thing that you kind of have to remember, you know, almost automatically, so that you don't have to think too much about it. And then you've got prepare the journal entry to record the redemption of the bonds at maturity. So remember, by the time we're at maturity, they can tell you, assuming the bonds were issued at 100, but they don't even have to tell you that, because once we're at maturity, the premium and the discount no longer exist. Okay, this is from the appendix of the textbook, which I don't expect you to read, but I'll just explain that over time, the premium and the discount are what we call amortized. They're recognized over time, so that by the time we get to maturity, there's no premium and no discount. Okay, so if this was the only sentence the question gave you, as soon as you see a bond being redeemed at maturity, it's always redeemed at face value, which is why the bonds payable is being debited with face value, 2,430,000. Cash is being credited at face value, and there's no gain or loss on redemption. There's no premium or discount. And that would be the case even if these bonds had not been issued at 100. Prepare the journal entry to record the redemption of the bonds before maturity. So there's the key word, right? Over here it was at maturity, so it's easy because you just do it at face. But now before maturity, you have to be careful because there may be a premium or a discount. You also may not possibly redeem it at face value, so you have to adjust the cash amount, and sure enough, you see here that it's before maturity, it's being redeemed at 98. As I explained to you, in prior lessons, this at 98 has got to do with how much cash you are paying in the redemption. So the 98% of the face value is going to be the cash amount. And then they tell you that there's a balance in the premium and bonds payable. It's now 9,400. So if you go back here, remember premium is initially recorded as a credit, right? Over time, the balance is getting smaller. So it got to the point where it was 9,400, but it's still a credit balance. In order to remove that premium, you have to debit it, right? So we said that there were 3 steps related to the journalizing of a bond that is redeemed before maturity. You have to remove the carrying value of the bond, right? And the carrying value in this case is debiting bonds payable because you're getting rid of the liability. You also have to debit the premium on bonds payable because you're getting rid of that account. It can't exist if the bonds payable is gone. You have to credit cash with the amount of cash actually paid. So it's going to be 98% of the face value. So it's less than the face value, 2,381,400. And then the difference is going to be either a gain or a loss. In this case, it's a gain because you owed $2,439,400. But in order to settle that account, you only paid $2,381,400. So you made a $58,000 gain. If you can't think it through that way, just remember the debits and credit dollar amounts have to equal each other. So this side was bigger, this side was smaller. So the difference has to go on the credit side, and a gain is a credit, all right? A loss is a debit. Questions? Yeah, this last piece is normally where people lose points on the test. So does anybody have, just checking the chat. Okay. Does anybody have any questions for me about redemption before maturity? Anything I need to repeat? All right, so hopefully that means that most people are comfortable with this. These are points that you guys should be getting relatively easily on the exam, I hope. All right, so brief exercise 1506, another attempt at calculating and journalizing a redemption. In this case, it's different because there was a discount on the bonds, there's a loss on redemption, so it's kind of the opposite of the other journal entry that we just did where there was a premium and a gain. All right, so let's read it. The balance sheet for Columba Consulting reports the following information on July the 1st, 2020. Long-term liabilities, so this is the balance sheet setup. Bonds payable, this would be face value because remember bonds are always recorded at face. Then there's a discount on that bond of 200,000. We have to remember that this discount would have been a debit balance because it's a contra liability. So the carrying value of the bond is 2.3 million. Kalama decides to redeem these bonds at 101 after paying annual interest. They tell you after paying annual interest because they don't want you to be concerned with having to calculate interest and record that journal entry before the bonds are redeemed. All right, so 101, 101% of the face value is what they pay, to redeem the bonds. So you can already imagine that there's probably going to be a loss here because they owed only 2.3 million, but they're going to pay 100%, 101, percent of 2.5 million. So they're paying more cash than what they owed. So how do we tackle this? Remember they ask you to prepare the journal entry to record the redemption on July the 1st, obviously, right? So how do we tackle this? It's the 3 steps. You get rid of the carrying value of the bond, which in this case is the bonds payable at face and also a discount that you have to get rid of. You calculate the cash that is paid, that's going to be a credit to cash, and then you calculate if there's a gain or a loss. In this case, remember, Wiley's always looking for the debits to go first and then the credits. So you may want to just write out your journal entry on a piece of paper first and then just order your debits and credits so that you don't get those red boxes, which in the end, sometimes it's just because they wanted the debit before the credit. So bonds payable goes out at face 2.5 million. The discount is credited with 200,000 because it would normally be a debit balance. Cash is 101% of 2.5 million, so 2,525,000. If you then look at the credits, they're much bigger than the debit. So there's a debit missing, 225,000, and a loss is a debit, right? So you can basically balance the journal entry that way. Or the other way to think about it is what I said before. You should anticipate that there's going to be a loss because they owed a carrying value of 2.3 million, but the cash that was paid is 2,525,000. So there should be 225,000 of loss. They overpaid in order to redeem the bond before maturity. Questions there? All right. So just to beat a dead horse here, we continue. And the reason, just checking what the next one is. Yeah, the reason I put in so many of these questions is because without fail, I don't know what the issue is, but without fail, this question and some parts of the mortgage question are very poorly done in the exams. So I guess I was just trying to make sure that you guys could handle the redemption questions, especially redemption before maturity. The following are 2 independent situations. Blossom Corporation redeemed 134,500 face value. So that's important, right? That's the face value. 13% is the annual interest rate bonds on June the 30th, 2020 at 104. So again, 104% of the face value is the amount of cash that was paid. The carrying value of the bonds at the redemption date was 123,500. If the carrying value of the bond at redemption is less than the face value, it means that the bonds were issued at a discount, right? It has to mean It has to mean that. So so you can actually calculate what the discount would be on the redemption date, because you say if the face value is 134,500 and the carrying value is 123,500, then it must mean that the discount was 11,000. If we go back to the previous question, when they set it out like how the balance sheet looks, if you wrote it out like this, you'd see that the discount was 11,000, right? Did the numbers just change? Oh gosh. I'll remind myself not to do that again. I don't, the algorithms are just so active. I keep forgetting, but in any case, now the numbers changed, so the discount is now 15,000. But nevertheless, the process stays the same. Let me make a mental note not to jump between questions again. So they do it at 108, so 108% of 122,100. That's the amount of cash that's paid. The bond is always going to be eliminated at face value. The discount in this case is 15,000. It's the difference between 122,100 and 107,100. Right, that's where the 15,000 comes from. And then you can already see, right, if you look at these numbers, that there's probably going to be a loss, because we're paying more than face value to settle a debt that was less than face value, right? So the easiest way to do it is just to populate everything and then calculate the difference between the balance on the credit side and the balance on the debit side to figure out how much is still needed on the debit side. And because it's a debit, it's a loss, because losses are carried on the debit side. Another way to do it is to compare the carrying value to the cash that is paid. The cash that is paid is 131,868. The carrying value is 107,100. So the difference is 24,768. Still a loss. Number two, Testove Inc. redeems 141,000 face value. So there's your face value. You know that bonds payable will be debited with that amount. 19%, very incredibly high percentage. 19% bonds on June the 30th, 2020 at 95. So at 95 means that the cash that is being paid is going to be less than face value. The carrying value of the bonds at the redemption date was 143. So if the carrying value is greater than the face value, it means that there was a premium. In this case, specifically a $2,000 premium. So we're going to pay less than face value for a bond where we owed money that was more than face value. So you should already be able to predict that there's probably going to be a gain, right? Because you're paying way less than face value to settle this debt that is above face value. The bonds pay annual interest, and the interest payment due on June 30 has been made and recorded. They're saying that because they just don't want you to even be concerned with calculating interest and thinking you have to pay interest as part of this transaction as well. So bonds payable, debit, 141,000. We already figured out that the premium is 2,000 based on the difference between carrying value and face value. A premium is normally a credit balance, so in order to eliminate it, you will have to debit it. And then to calculate cash, you're going to say 141,000 times 95%. So the cash is only 133,950. If you compare the 143,000 that you owed to the 133,950 that you paid, you see that you made a gain of 9,050. If you can't figure that out, you say, well, there's 143,000 on the debit side, there's only 133,950 on the credit side, so I still need $9,050 on the credit side, and a gain will be a credit. Questions? Yeah. All right. Okay. Now we move into the world of mortgages. This should have been a fairly easy one for you to deal with. Carla Vista Inc. issues a $720,000, so that's the face value of the mortgage note payable. 10% is the annual interest rate. 10-year mortgage note is the term on December the 31st, 2020. That's the issue date or the borrowing date to obtain financing for a new building. The terms provide for annual installment payments of 110,000. So you want to be careful, right? It's not semi-annual, it's annual. So you're just working with the 10%. You don't have to multiply by 6/12 or divide by 2 or, only use 5% or whatever. Prepare the entry to record the mortgage loan on December the 31st, 2020. That's one part of the thing. And then the first installment payment on December 31, 2021. So when we borrow, we receive the cash. So we debit cash and we credit mortgage payable. And for the first installment, remember, you already know what the cash amount is going to be. You're paying cash. So you credit cash with 110,000. You have to calculate the interest expense. Remember, you apply the interest rate to the principal balance. For the first installment, the principal balance is the total amount that you owed. So you're going to say 10% multiplied by 720,000 is 72,000 in interest. And the amount that you actually are paying off of the debt is only 38,000 because it's the difference between the cash that you paid and the interest expense that you have to recognize. Questions, anybody? All right. So the next one is, I think the first part is okay, but then the second part gave people some hassles. So I'll try to, when we come to the B part, I'll try to go a little bit slower. So Blossom Company borrowed $300,000. Again, that's the principal amount of the mortgage on January 1st, 2020, the borrowing date, by issuing a $300,000 8%. So there's your interest rate, mortgage note payable. The terms call again for annual installment payments, so only once per year, of 41,000. So this is the amount of cash that you pay every time on December 31, the date. Prepare the journal entries to record the mortgage loan in the first two installments. So obviously you're going to record the 300,000 first. It's exactly the same as the previous example. You debit cash with the principal amount and you credit mortgage payable. Watch the date, should be January the 1st. The other payments now, the first payment happens on December the 31st, 2020, because 1 year has passed. Your cash paid should be 41,000. Your interest, you apply the 8% to the entire, for the first installment, gets applied to the entire mortgage balance. So 8 times 3 is 24, right? So the interest expense is $24,000. And then the mortgage payable, the decrease to the liability, is the difference between these two numbers. All right, so by the end of, let's see if I can, okay, never mind. I thought I could show it a different way. So by the end of 2020, right, December the 31st, 2020, you actually have a balance on the mortgage that is $17,000 less than what you started with. So it's going to be $283,000. All right, this is what I was trying to show over here, but I don't see them. Yeah, so I mean, this is the calculation that I'm talking about. In 2021, the balance that is still owing on the mortgage is 300,000 minus 17,000, so 283,000. And that 283,000 multiplied by the annual interest rate gives you an interest expense of 22,640. So that's where that number comes from. The cash always stays the same. The difference between the cash that was paid and the interest expense is going to be the reduction in the mortgage balance. Questions on this first part, part A, before I go to part B? All right. So now we come to the part, like I said, where some people were having difficulty. This is where you have to say how much of the mortgage was is current and how much is long-term. But you have to watch the date that they're asking you for. So they say indicate the amount of the mortgage note payable to be reported as a current liability and as a long-term liability at December the 31st, which year? 2020, right? So if you're sitting at December the 31st, 2020, you've already made this payment. Okay, so you can't include these amounts into anything because you've made the payment and they're asking you now at that date, what amount of money will you pay against the mortgage balance in the next year, right? That would be the current amount. So by 2021, how much of the mortgage is being paid off? And here's the answer, right? Not the 41,000. We spoke about this at length when we were doing the examples in class. The entire cash balance cannot be what you're paying off on the mortgage because part of that cash balance is an expense in the form of interest. So it has to only be the piece that actually reduces the mortgage balance. So between this date and this date, what are we paying? It's 18,360. Now you may remember from our class example that we had semi-annual installments, and so that was every 6 months, and that's why we added two numbers together to get to the current liability. But you have to read these questions carefully and make sure you understand what's going on. Because this is an annual installment, the current liability for the next year is only going to be one payment, right? Not two. This payment was already made. So current liability, 18,360. How did we get to the long-term liability? Well, you're saying you started with 300,000. You already paid off 17,000. And then by the end of 2021, you would have paid off another 18,360. So whatever is left over after that, right, to be paid in more than 1 year, that's going to be the long-term liability. In this case, 264,640. So this is what they show in the calculations as well, right? That to get to the long-term liability, you're saying I already paid the 17,000. The 18,360 is what I'll pay for the current liability in 2021. So at the end of 2021, 264,640 is what I still owe to be paid in future years. Questions there? Again, this is usually the part that trips people up. So if you didn't do this part, or you got it wrong, you gave up or whatever, please go back and make sure you understand where the numbers are coming from. Also, there's an example like this in the textbook that I went through with you guys, and we went through this example, I think twice, this type of example twice, or in two different ways in our classwork. So hopefully by now, or by the time you finish studying, you should be good. All right. So that's current and long-term liability. Okay, the next question is the difference between issuing stock or issuing a bond, right? What makes more sense? Yeah, I find that the biggest problem that people had was, and this isn't really stated in the question, so I can understand why you would have a problem with this. It's implied in the issuing bond section that you should understand that there are already 490,000 shares outstanding. Remember, this is the same company, right? So issuing bonds doesn't add to the number of shares. So this is the pre-existing shares. And then for the issuing shares piece, they add another 180,000. That's where the 670,000 comes from. A lot of people just try to put 180,000 over here, which obviously can't be the case because we're saying this company is already in existence. They already have shares outstanding. They're trying to decide whether they should issue bonds or issue shares. So Faro Inc. is considering two alternatives to finance its construction of a $1.8 million plant, issuing 180,000 shares of common stock at the market price of $10 per share, which will obviously give them the money that they need, or issuing a 1.8 million 7% bond at face value. Complete the following table. Okay, so the income before interest and taxes obviously going to be the same for both companies. There's no interest expense for issuing stock, right? But here's the interest expense for the bond. How did we get to that? 7% of 1.8 million. The reason it has a star is because you could have also put it as a negative number. So what this shows you here is that, and we spoke about this before, is that one of the benefits of bonds or taking out debt is that the interest is tax deductible for the company, so it lowers the net income, so eventually also lowers the tax burden. But obviously, you still have to pay that interest, so it does take up more of your cash. So the income before income taxes, 670,000 for the stock, 544,000 for the bonds. Income tax expense, there you have it. It's 201,000 for the stock issuance, but only 163,200 if you have the bonds, because your income before income taxes was lower under the bond, and so your net income is lower here as well, but you had some savings on taxes. So, it's up to the company if they perceive the benefit of the tax savings to be greater than, the cost of having to pay this interest. Outstanding shares, again, it's the 490,000 that previously existed plus the 180 to get you to 670. How do you calculate earnings per share? Remember, we went over this actually in chapter 14. It's the net income minus any preferred dividends divided by the shares. In this case, there's no preferred stock, so you just take the 469,000 divided by 670,000 shares, so you get 0.7 or 70 cents is your earnings per share. For the bonds, they may have a lower net income, but because they also have a lower number of shares, they actually end up having a higher earnings per share of 78 sorry, not percent, 78 cents. So net income is higher if you have the stock issuance, but earnings per share actually ends up being lower than if you did the bond option. So it's up to the company. I mean, the way sometimes the markets operate is that, if a company may have great revenue, but if the earnings, so the net income number is really small, then, the stock price will suffer. And if the earnings per share doesn't meet analysts' expectations and stuff, then the stock price will also suffer. So there are multiple things to consider when making these decisions. Again, the company also just has to consider practical things like, do we have the money to pay interest all the time? Do we want to have to pay all of this money back at the end? With the shares, do we want to give up ownership of our company, to people, etc.? So there's no right answer here. In terms of what is preferable, it just depends on the goals of the company. Any questions there? All right, so here goes the last homework. The adjusted trial balance for Oriole Farm Corporation at the end of the current year contained the following accounts. You've got interest payable. Interest payable is normally going to be a current liability. Okay, people are generally not going to wait for more than 1 year to get the interest payment from you. A lease liability is going to be a long-term liability for the most part, because remember, if you read in the textbook, it says any lease that is more than 1 year has to be recorded as the right of use asset debit and credit lease liability. So because by definition, this lease liability relates to a lease that is more than 1 year, it has to be a long-term liability. Then you've got bonds payable due 2025. Clearly, if we're sitting in 2020, this is going to be long-term. And then the premium or the discount will always go wherever the bond goes. So it doesn't have to say that the premium due 2025, the premium is not really due, but the premium belongs to a bond that is due in 2025, so it has to go with the bond. Prepare the long-term liability section of the balance sheet. Here's the balance sheet, name, and so on. You didn't have to do anything there. You did have to put long-term liabilities as the subheading. Bonds payable, 175, 400. Add or subtract, you got to know that a premium is added. add the premium on bonds payable of 24,000 to get you a carrying value for this bond of 199,400. Lease liability, as previously discussed, 85,400 is in there. Notice how the interest payable didn't make the cut because it's current liability. So the question is basically just testing to see if you understand that interest should not be part of the section of the balance sheet. And then you just total your long-term liabilities, 199,400 plus 85,400 is 284,800. Questions there?
Nope, we're good. Thank you, Professor.
So that's the end of the chapter 15 homework explanation. As I said, it was due on Friday. Your chapter 17 homework, just while I'm here, I might as well just go into this, is due on the 25th, which is next week, Monday. So we, for the most part, are basically done with chapter 17, although we'll do another example now and I'll discuss free cash flows again. But you should be able to, now that hopefully maybe you took a little bit of a break, some of you, after finishing 15, you should be able to do basically everything in 17. The quiz and the test will open, and I'll go over the prep sheet now. The quiz and the test will open on the 24th, which is next week, Sunday, and close on the 31st. They actually open before the homework for 17 is due. I just always try to make the homework due. Although I forgot that it was Memorial Day, I tried to make it due on a day when we still have office hours, but you guys will just have to ask me questions via email. So the test and quiz information is up. I put it up sometime yesterday morning. I know it's early because it's only starting on the 24th, but I thought it would just be useful for you to see what you're going to be tested on, so that as you plan for it, you know where to put your emphasis. So all the stuff at the top here it's not mandatory. This was just me selecting some additional practice questions if you wanted to do them for 15 and 17. But remember, if I can just go away from this for a second, remember that I also put the full solution for after the homework is due. I put the full solution for the homework on the solutions tab. So if you guys want to select additional questions that you want to do yourself, the answers are there. As usual, the quiz is 2.5% and the test is 20%. Again, when you look in Wiley, sometimes it's not weighting the quiz and sometimes not weighting the test. I can't weight the quiz in Wiley because it doesn't accept a half. It doesn't accept a part of a percent. It always has to be a whole percent. And because this class was supposed to be in person, I wasn't expecting to run everything through Wiley. The test is 20%. I have to see if I've actually weighted it in because I think some of the tests I never weighted in when I set them up. So it will be available from Sunday at 9 a.m. on the 24th to Sunday, the 31st at 11:59 p.m. Same deal as test one. It's a timed assignment. You kind of have to make sure that you are ready to do it. Don't try to open multiple instances of Wiley, because it will just kick you out of the system and then you won't be able to go back and finish the test or the quiz. And also, make sure you're doing it on a laptop or something, because a mobile device like a phone and so on will not be able to do that test. And like I said, I included some questions if you want to do them. It's the same idea again. I gave you 10 quiz questions. It's 120 minutes. You really should be fine with time. Whether you get 10 out of 10 is up to you. Make sure that you study. Do the quiz before the test. The test is obviously 15 and 17. It's open the same time as the quiz. There's again going to be 10 multiple choice questions, a combination of definitions or theory, journal entries and calculations, and 6 exercises. The exercises are similar to the homework and textbook examples. The scoring approach is the same. okay? There's no account names. You can choose on the second attempt if you want to use the drop-down menu. After the fourth attempt, you start losing more points. So, just watch out. And as usual, please study. Don't treat it like an open book test where you think you're going to be able to find all the answers in real time, because you will lose a lot of time, even though I'm giving you 4 hours to do it. It's amazing how quickly the time can go. So try to revise before the time so that you aren't scrambling trying to find answers from scratch. The test is 20% of your grade, already discussed. Exercise 1, bond issuance at face value with interest payment and interest accrual. It's almost like the first homework example. So hopefully that's not a big deal. Bond issuance at a discount, you totally know how to do that by now. Bond issuance at a premium. Bond redemption at maturity and before maturity. Like I said, at maturity, it's just face value. Before maturity, people usually have issues, so please practice the before maturity redemptions as well. Journal entries for mortgage note recognition, so just the face value or the principal amount of the mortgage note, and then you also have the first two installments. I feel like this question also asks you what is the current liability and the long-term liability. So it's basically a carbon copy of the question that you had for homework. And then what normally trips people up, and I mean, I'm just putting the questions in the order of the chapters, like chapter 15 came before chapter 17, but for some reason, especially I sometimes would get frantic messages where people are like, oh, I didn't realize that the last question was going to be so long. It's a statement of cash flows. And I'm like, well, throughout the first 5 questions, I haven't tested cash flows yet. So the last question is a cash flow. I would say that you have to really be careful and leave yourself more than enough time to finish it, because it's going to be a lot of points. And you don't want to be hanging around on exercise 1 through 5, for 3 hours or 3.5 hours and then trying to scramble to get to the statement of cash flows. Please just be aware that you have to manage your time appropriately. So what are some of the things that you need to do? Remember, I told you that you don't have to memorize, the flow, the cash flow. Please have the sheet or whatever next to you while you're doing the test, so that you can remember how the names and things go throughout, so that you don't get tripped up. Because remember, you can't go into Wiley while you're doing the test. So if you don't have templates and things in front of you, you might get stuck, and it's really unnecessary to get stuck that way on stuff that could easily have been looked at via a template. And I'm saying this again because remember, if we were in class, I already told you that I would have given you the template for the cash flow. You would have just had to fill in, I'm not going to tell you that it's, for instance, an increase in accounts receivable or whatever, but, for the most part of the rest of the stuff, the names and everything is there, so that you're not staring at a blank page thinking, how do I create this cash flow statement? Does anybody have questions on the test and quiz prep sheet? All right. So that's fine then. We're good. Let me just go back to this concept of free cash flow then before we move into, sorry, it's not around zero. Okay. Before we move into doing another cash flow example. All right, so like I said, free cash flow is a very small topic, so much so that I don't even really have a blurb in our notes on it. So I'm just going to go by the textbook discussion of it. Free cash flow is a concept that is heavily used in finance. Like people who are investors often are looking at a number like this to be able to project out what we would call a valuation, what the value of a company may be, because they're kind of interested if they're investing in how much cash is being generated by the business after any payments have been made to sustain the business. So that would be things like the capital expenditure. And capital expenditure just means that you have to buy equipment, that you have to, buy vehicles, that you have to build a factory or whatever, buildings and so on. And also, any payment to stockholders for dividends, you also really can't count as money that would come back to you, as someone, putting maybe like a venture capitalist or something, putting money into the company. So yeah, you can see in the statement of cash flows, net cash provided by operating activities. We already know what this is. This is the operating activities section of the cash flow. It's kind of showing how much cash the company is able to generate through its day-to-day activities, right? So, when you look at that number, you kind of have an idea of what the company is capable of in terms of cash generation. However, as I said, it's often to do with financial analysts, people who are looking to invest in companies. They have sometimes said that net cash provided by operating activities fails to take into account that a company must invest in new fixed assets just to maintain its level of operations, right? And the company also has to maintain current dividend levels to satisfy investors. So they're saying, yes, you can use the net cash provided by operating activities as a type of indicator of how much money the company is able to generate, but you can't ignore the fact that in order to generate that money, they have to keep investing in assets, fixed assets, and they also, want to be able to keep up with their dividend payments. So that's how we get to this concept of free cash flow, because they're saying, okay, you start with a net cash provided by operating activities, but then you have to adjust it for the payment for fixed assets that's needed and for the payment for any cash dividends. And then an analyst or future investor will say, okay, this is actually the money that the company is able to generate. So if you're looking to invest in a business, some of the things that you would consider, or one of the big things that you would consider, is how old is the company's assets. Because if the company's assets are pretty new, then you know that the money that you're generating, you won't have to so quickly pour it back into the company to buy fixed assets. But if you're buying a company and it turns out that most of the assets are really old, then it's important to know that, because it means that any money that you're generating, you probably will have to throw back into the company. And often when people are investing in companies, they don't necessarily want to see all the money that they're investing just going right back in with no money coming back to them, because the concept of a payback period, like how quickly will I get my money back out of this investment, is actually a pretty important concept in finance. So that's the formula. And if again, this is the type of thing that you also want to have handy when you're taking the test, so that you're not scrambling to remember how this formula goes, because you may be asked as either a multiple choice question or the B part or the C part of a statement of cash flows to calculate free cash flow. So consider the following example. Suppose that MPC produced and sold 10,000 personal computers this year. It's reported 100,000 net cash provided by operating activities. In order to maintain production at 10,000 computers, MPC invested 15,000 in equipment. This is capital expenditure, right? It chose to pay 5,000 in dividends. Its free cash flow is going to be the 100,000 net cash provided by operating activities minus the 15,000 that's invested in equipment, which is capital expenditures, minus the 5,000 that's paid in dividends. So the free cash flow is 80,000. The company could use this 80,000 either to purchase new assets to expand the business, or to pay an 80,000 dividend and continue to produce 10,000 computers. So what they're saying is that eventually the actual amount that is free to be used in whatever way we see fit is only 80,000, not 100,000. This is very similar to your own bank accounts, right? You may have gone online this morning and checked your bank account and you see $1,000 there, and you can be like, yes, I've got all this money in the bank. But then you start to realize, oh, $200 is already, promised to buy a piece of computer equipment. Then I have to pay, another $500 for a payback of a loan, or I have to pay another $500 for rent or something like that. Then in the end, you're like, okay, my free cash flow is actually only $300. And so I have to make decisions based on $300, not based on $1,000. And this is the same notion that these companies are working with. Any questions there? All right. So now this is what we'll do. I want you guys to take like maybe 5 minutes. I don't know if people are even in Blackboard. Maybe I need to give you 10 minutes to go into Blackboard, uh, go and look at the Zoom call materials for today, which is the 18th. This practice exercise 17.2 is a cash flow that we'll be working on, but I'll obviously read it through with you, but I'm going to let you guys work on it by yourselves. So I want you to go in and pull down a copy of that so that you have it, because it's a long question. So I mean, I guess I could make the font smaller, but it's kind of difficult for me to put the entire question on one sheet so that everybody can see it while they're working. So go ahead. I'm gonna say, I'm gonna give you until 11:40 for sorry, people to pull this thing down if they haven't already, and then we can start. I'm just gonna step away from the computer for like 2 minutes. So hang on, make this a little bit bigger since most of you should have this. If you had a problem, I should have said this before, sorry. If you had a problem pulling the document down from the from Blackboard, it is also in Wiley Plus. It's problem exercise 17.2. So it's existing in various places. So we've got strong cooperation with comparative balance sheets for December the 31st, 2020 and 2019. So we know already, right, because we've been through this many times with the statement of cash flows, we know that the cash flow has to end on 28,200. Right, that helps us. And we also know that the beginning balance is 17,700. So we can actually calculate to see the change in cash for the year. And that's the change that we will use the cash flow to explain. All right. We also see here that we have accounts receivable. So that is going to be a current asset. Investments is not a current asset. It's going to fall under investing activities. Similarly, equipment, anything to do with equipment is also going to fall under investing activities. Accounts payable is a current liability. So this will go under operating activities along with the change in accounts receivable. Bonds payable is part of financing activities, but we see that the balance went down by 20,000, but we always want to be careful to make sure that this is not like a non-cash activity or something. Similarly, common stock is part of financing activities, but you also want to be careful to make sure that it's not any type of non-cash financing activities. We will be able to see that by reading the additional information. Remember from before I said that you don't have to look at the change in retained earnings as any type of cash movement. You just have to remember that retained earnings changes based on net income and any dividends that are paid. So sometimes you may need to look at it for the sake of seeing the dividend, but I believe this question gives us the dividend already. All right. So looking at additional information, sorry, this didn't render so well. There's not supposed to be, it doesn't matter, but there's not supposed to be bullets here. So net income was 28,300. So there you have the number to start your operating activity section, right? Dividends declared were 26,400. So that's going to be part of financing activities. It's an outflow, so you don't actually have to calculate the amount of dividends that was paid. You are just able to see it from the additional information, so that's helpful. Equipment which cost $10,000 and had accumulated depreciation of $1,200. So you have to ask yourself, how much is the book value, right? If something cost $10,000 and it had accumulated depreciation of $1,200, what was the book value? And it was sold for $4,300, right? So the gain or the loss is the difference between the cash received and the book value. And book value is cost minus accumulated depreciation. I've said this many times over. Remember that the gain or the loss goes into operating activities, and the cash received I'm giving you many hints here, right? So hopefully it helps. Is investing. All other changes in non-current account balance had a direct effect on cash flows. So that means that this change in common stock was for cash, change in bonds payable was a cash payment, except the change in accumulated depreciation. So what they're saying is you have to calculate what is depreciation expense, bearing in mind that there was a sale, right, of equipment. So you can't just assume that accumulated depreciation was $4,000 because remember something was sold. So based on the previous example that we had in the class, it was example number 5, I believe. Yeah, example number 5, you can see how you draw up an accumulated depreciation account when there is a disposal or a sale. So they're asking you to prepare a statement of cash flows for 2020 using the indirect method, and then also in part B, to calculate free cash flow. So what I will do, so it's 11:45, what I'll do is in about maybe 20 minutes, so at 12:05, I'll give you a check total for operating activities, and then you can carry on from there. I'll say that I think the best way, maybe if you have questions, is just to hit me up in the chat box so that I can answer them. But for the next, 30, 35, I don't know how long it's going to take, it depends on you guys, minutes, I'm just going to leave you to do this example on your own. I highly recommend that you actually do this example and not do something else during this time, because this is going to be a good practice for you to be able to see where you are at with cash flows. But I'm here to answer any questions. All right. So first of all, before we even start, does anybody have any questions about this example? Anything that you need me to clarify further? Okay, there's some questions in the chat, but I
The
don't
loss of
think.
disposal.
Sorry, what about the loss on disposal? Are you asking if there's a loss?
Yeah.
It's possible, right? Because it looks like there's likely a loss. So I'm gonna say yes. All right. Why don't I just actually I'll stop the share and then I'll come back and I'll put the check total for the operating activities. I'll just put it in the chat window so that people at least know what number they're working towards. I don't think I have to wait 20 minutes to tell you that. All right, so go ahead. We'll give it maybe 30 minutes and see where people are at. And I'm going to just go look up the total for operating activities quickly. Again, if you can't get this page to function properly on your computer for any reason, it is practice exercise 17.2 in Wiley Plus chapter 17. So you should be able to do it either way. All right. The solution. Obviously we're not in class, so I can't check to see how far everybody got. I hope you got to a decent point in your work. I'm just going to go through the solution, assuming that people were trying to get there themselves. So obviously the usual, the name of the company, the name of the statement for the year ended December 31, 2020. The net income was given to you in the question. So you start with net income at 28,300. The depreciation expense was not given to you in the question. You either had to do some calculations or maybe even make the depreciation accumulated depreciation T account, which I'll do over here quickly so that we can just see how these numbers came about. All right, I know for those of you who figured it out already, this may be a little bit tedious, but just bear with me. So when you are given a question and you cannot figure out the accumulated depreciation just by looking at the account, your best bet is probably just to draw up the T account. So if we go back to this question, we see that accumulated depreciation, the beginning balance was 10,000, the ending balance was 14,000. So remember to contrast it, so the balance is on the credit side, so beginning balance 10,000, right? You have, I'm just going to leave some space here. You have an ending balance on the same side of 14, right? Let me check out 14,000. So it's easy to think that depreciation expense must be 4,000, but that's not correct because there was also a sale. And if you look at the question, remember it said that the equipment that was sold had accumulated depreciation of 1,200. When there's a sale, you debit the accumulated depreciation account with the amount of accumulated depreciation on the asset that's being sold. So that was $1,200. So it turns out that depreciation expense is actually $5,200. How did I get there? I said, well, to get from 10 to 14, but you're also subtracting 12, it must mean that it's 5,200 in depreciation expense. Questions, anybody, or do I need to repeat this concept? A little bit tricky, so just making sure. All right, so I don't hear any questions, so I'll move on. So that was the depreciation expense, 5,200. Then we've got the loss on disposal of the equipment. Remember, I wrote for you over here that when we were going through the question, that the gain or the loss is the difference between the cash that was received and the book value. So in this case, the cash was 4,300. The book value was how much?
10,000.
Not 10,000, the book value. 8,800, right? Oh, sorry. Because it's going to be the
Yes,
10,000 minus 1,200. So cash is clearly less. So there's going to be a loss. And the loss is how much? My math good, 4,500. Okay, so what you're saying here is we received cash of 4,300 for something that we thought was worth 8,800. So we must have lost money. We did lose money, 4,500, but remember that loss has already been deducted to get to net income. So in order to neutralize the effect of the loss, you have to add it back, right? So that you don't double count, because you count the sale of this equipment in its entirety under investing activities. There was an increase in accounts receivable. If you look at the numbers, you can see the increase there, right? Increase in, in accounts receivable of 1,900. Sorry, I jumped over accounts payable of 1,900. An increase in accounts receivable means that we did not collect all the money from our customers for all the revenue that we generated. So this is a subtraction. Increase in accounts payable, we also had over there, right, of 8,500. An increase in accounts payable means that we didn't pay off all our expenses. So we had extra cash, which isn't reflected in the net income number. So adding these three numbers and subtracting the 1,900 gives you an adjustment, total adjustment of 16,300. When you add that to the 28,300, you get to net cash provided by operating activities of 44,600. Any questions on this first third of the cash flow? All right. In investing activities, we know that we sold equipment for 4,300 cash. It's the cash amount that is going to be picked up, and it's given to you over there. The other investing that you had was this purchase of an investment, which is a cash outflow. Remember, it said that all the changes were related to cash. So you purchased investments to the value of 7,000, and it's a minus because you bought something here, you sold something, so that's a plus. These two numbers together are negative 2,700, and that's why we say net cash used by investing activities. So that's the investing activities. And then we've got cash flows from financing activities. And again, these are the headings and things that I'm saying, you need to have some type of template next to you eventually when you're taking the test, so you don't have to try and remember all these things. So you have the common stock that was issued, $15,000 worth of stock. You've got 20,000 payment for bonds payable, and you've also got 26,400 dividends payment. So the issuance of common stock, you obviously debit cash, credit common stock. So that's money coming in. Retiring a bond is money going out. Paying a dividend is also money going out. So these three numbers together end up on negative 31,400. So it's again net cash used by, in this case, financing activities. So together, the 44,600, the negative 2,700, the negative 31,400 tells you the change in cash for the year. It's an increase in cash of 10,500. You could have predicted that just by looking at cash on the balance sheet, right? 10,500 increase. So you already know that that's the increase. So that number can be plugged in. And then cash at the beginning of the period, 17,700, that number is given, right? Because the ending 2019 cash is the beginning 2020 cash. And so we end up with cash at the end of the year, or at the end of the period, of 28,200. And like I said, if you know how the cash flow works, when you see the cash balance on the balance sheet, you already know what your answer should be at the end of the cash flow, because you have to come back to this number, 28,200. Questions on any part of the cash flow before I do the free cash flow calculation? Okay, so you guys are gurus now, right? So for free cash flow, remember it's net cash provided by operating activities minus any capital expenditures. Capital expenditures mean expenditures for things like buildings, equipment, land, you know, things, fixed assets, things of that nature. So investments is not a capital expenditure. And then you also subtract any dividends paid. So if you look at part B, where it asks you to calculate free cash flow, you're going to start with net cash provided by operating activities. You're going to look in the investing activities section to see if any money was spent on fixed assets. It wasn't, right? Again, investment is not a fixed asset. If we had purchased equipment, we would have used that amount, but we sold equipment. So the sale of equipment shouldn't go in. Capital expenditures is only about purchasing things, property, plant, and equipment. All right. And then we have the payment of the dividend of 26,400. So that gets subtracted. So in the end, our free cash flow, even though our net cash provided by operating activities looks, you know, pretty good, 44,600, if we take away the money that's paid to outside people, in the end, we only have $18,200 to, you know, that's actually free, loose cash. Any questions on the free cash flow calculation?
Nope, thank you, Professor.
All right, so that certainly now does conclude chapter 17, cash flows. So unless, you know, people have any other major questions, this is it for today. I'm not going to touch on, remember I said I'm not really that phased about touching on chapter 18. I just put the handout there in case we really had a lot of time. I encourage you to start doing your homework for chapter 17 as soon as possible, because again, it's time consuming to really go with the flow of the cash flow. Remember that, and I've said this before, but I'll say it again, I do have there's two videos where I work through exercise 17-8, which is one of your homework exercises. Then the amounts will probably not be the same, but the you know, the mechanics are being explained. Yeah, so that's about it. So if you're dismissed to go and have a lovely day, if anyone wants to stay on, I'll stay on for another 10 minutes to answer any questions. And then I do have office hours at 1 p.m. as usual, if anybody needs to talk to me at that time. Okay, but if not, it was good to see, quote unquote, you guys, and I'll see you on Wednesday.
Thank you, Professor. You too. Take care.
Okay, cheers, bye.
Thank you, Professor. Take care.
You're welcome. Have a good day.
Thank you, Professor.
You're welcome. Bye-bye.
Story though.